Tonight is the second in a series of panels that has been convened by Professor Paul Wachtel, Professor of Economics at the Stern School of Business, and I'm very grateful to him for organizing this series. It is one of a number of programs that we are sponsoring over the course of this, our inaugural year in 19 Washington Square North, to highlight topics of interest to NYU Abu Dhabi and the curriculum that we're developing there. We are in the process of recruiting our first class of students who will enter next September. And I am actually just back this morning from Abu Dhabi because 2 days ago we dedicated our downtown campus where we will run our college and a variety of public programs for our first 4 years while our permanent campus is under construction. So we are very much on the move, and your participation tonight is another part of is an example of the connection that we hope to build strongly between NYU in New York and NYU Abu Dhabi. So thank you very much for coming tonight. And I invite Paul to tell you about tonight's program.
Thank you to Hilary for the introduction, and thank you for joining us this evening. The financial crisis of the last couple of years was probably the most serious financial crisis, or was clearly the most serious financial crisis since the Great Depression. Now, the crisis began gradually with problems in the American mortgage market starting as early as 2005, 2006. But for most observers, Ben Bernanke, myself, and everybody else, it seemed to only indicate that a minor cyclical adjustment was underway. It was only in the summer of 2007 that it became apparent that something else was going on. European money markets seemed to dry up all of a sudden when some hedge funds and money market funds linked to the mortgage markets faltered. The failure of Northern Rock, a British banking institution, and the enormous write-downs of bad loans by U.S. banks followed in the fall of 2007. At that time, central banks around the world responded quickly with enormous and unprecedented provisions of liquidity to financial markets, which seemed to stem the crisis in the minds of most. I was convinced, but it was only for a while. Bear Stearns had to be taken over in March of 2008, and losses elsewhere in the financial system, both in Europe and the United States, mounted quickly. By September, though, things took a real turn for the worse. An apparent run on Lehman Brothers looked like it would lead to a classic financial panic. The Fed and the Treasury moved quickly from the provision of liquidity to direct support of financial institutions. Now, these interventions stemmed the panic effectively and are only slowly beginning to be unwound today. Now, why did this all happen? This is supposed to be the 21st century and not the Depression era. The extensive regulatory framework designed to prohibit such problems seems to have failed us. Perhaps the problem just started in the activities of unregulated pockets of the industry, derivatives markets with strange contraptions which nobody really understands, and mortgage markets with similarly strange and new contraptions which are hard to understand. Perhaps no one really knew what these instruments were all about and understood the risks inherent in these new instruments. Perhaps the regulators were asleep at the wheel, a little tipsy from having drunk a little too much free market punch in the Greenspan era. We have an opportunity this evening to discuss some of these questions with a very distinguished group of panelists who I'm honored to be with. We will start the conversation looking a little bit backward, trying to figure out how the wonderful systems of the 20th century failed so miserably as soon as the 21st century began. But more important than dwelling on the past, as much as we like to express our anger at Wall Street salaries and Washington bailouts, is the future. Focusing on the states might be easier, but we won't entirely. But it's easy because there are major bills pending right now in the House and in the Senate that will make major changes to the regulatory structure here in the United States when they're passed. So our second focus of interest this evening should be on the changes to the regulatory structure and what new approaches are really necessary to prevent crises from emerging again. If we look back in history, the Fed was established in 1913, following a period in the late 19th century where there were at least 5 serious late 19th century, early 20th century, in which there were at least 5 serious banking panics in the United States. It took that the experience and then the Depression experience of the 1930s to put the financial regulatory structure that we know together. It served us well. For the rest of the 20th century, we did not have any serious financial panics, with perhaps the exception of the savings and loan crisis in the 1980s. But that was costly, but survivable, and not really a systemic panic. However, the 21st century apparently needs some new thinking. And I'm going to turn to our panelists to help us sort of build the kinds of thoughts that are necessary to make sure that the first quarter of the 21st century looks like the last half of the 20th century and not the last quarter of the 19th century. We all hope that this panic is not the first of a string of 5 that will characterize the 21st century. But we've all got to figure out how that's going to be put together, and for that, I'm going to turn to our panelists, who I'll introduce now. On my far right is Boris Vujcic, the Deputy Governor of the Croatian National Bank, who is an old friend of mine because we cooperate together every year in planning a program for the Dubrovnik Economic Conference put on by the Croatian National Bank. Boris has extensive experience with the bank, a PhD in economics, and he's also the chief negotiator with the European Union, involved in talks regarding Croatia's accession to the European Union. My understanding is that a border dispute with Slovenia, which looms large in Croatia, doesn't loom so large in New York, is on its way to being settled, which should smooth out these negotiations, and Boris should be off to Brussels and help take Croatia into the European Union, hopefully soon. In the middle is Rodgin Cohen, who has a long and a distinguished career at Sullivan and Cromwell. He's the chairman of the company right now and is well known to everybody I talk to as the lawyer in New York on any banking issue whatsoever, with experience and expertise in all aspects of banking law, banking regulation, advising institutions and advising governments for many, many years. And we're honored to have him with us this evening and look forward to his views on some of these issues as well. And finally, to my immediate right is Acharya, my colleague at the Stern School of Business of New York University, professor of finance, a PhD in finance from the Stern School, who then left NYU to spend a few years in exile at the London School of Economics, but to our great fortune was lured back to New York to our finance department, and has been an enormous influence in the finance department in terms of being a catalyst for discussion on the kinds of issues we're talking about this evening, and for research on financial intermediation. With his leadership, and he's going to be embarrassed to hear me say this, but I really do mean it, the Stern School put together an effort last year to analyze the crisis, which resulted in a book published last March called Restoring Financial Stability: How to Repair a Failed System, which was in actuality the first serious study of what was going on, with some serious academic comment about the kinds of things that need to be done to repair the situation. It had a multitude of authors, including myself for chapter 2, but it came into being very, very quickly through the leadership provided by Viral in the faculty of the Stern School. And in fact, I'm glad he was able to get away from the office this evening, because he is in the process of putting together an e-book published tomorrow, hopefully, which will be the Stern School's faculty's commentary on the legislation pending now in the House and the Senate. So that perhaps might come up in our discussions today. Let me just ask one question, the first kind of question that I said I would start with, which is to take a short look backward and see what our panelists how they might view recent history. As I said, few would disagree with the suggestion that inadequate regulatory structures or the failures of regulations themselves or regulators themselves were important contributory causes of the crisis. What was going on that got us into such a damaging situation so quickly and with such great surprise? Turning to my immediate right, Viral.
Yeah, thanks, Paul, for the invitation, and thanks for being here. I was actually rather flattered rather than embarrassed. So.
Thank you. Good.
Thanks. Yeah, so my view of the crisis is relatively simple, which is that essentially most parts of the financial sector had taken what I like to think of as, was doing what I like to think of as a carry trade. So a simple way of thinking about a carry trade is that you are walking up the steps and you're going to come down the escalator very rapidly. And you're going slowly up these stairs because along the way you're trying to finish your Coke, eat some candy, have a good time, talk to your wife. But once you go up, you realize there's nowhere else to go, and you come down very rapidly down the elevator. And so to just give you an example, suppose I'm a bank and I just create a lot of mortgages in the economy. I lend effectively to whoever comes to me to borrow. As long as house prices keep going up, this is going to work fine. So I go to a subprime borrower. The subprime borrower is already paying some rent on his house. I tell him, listen, let's convert your rent into a mortgage payment. You'll get a tax deduction. You don't have to pay me anything. It's essentially a zero down payment mortgage. As long as house prices keep going up, you will actually build some equity. And if house prices don't go up, you can default on the mortgage. And ordinarily we would think, oh, why would the bank do such a silly thing? Because, when there are defaults, it will be quite painful for the bankers. But the issue is, and I think this is what we'll probably discuss a lot, is whether banks are actually paying a fair price for the debt that they raise in the economy. Implicitly or explicitly, bank debt seems to be guaranteed by the governments. They actually don't pay a fair price for this. And so once I'm levered up 80%, 90% through debt, effectively for bankers, the best thing to do is to do anything that's going to keep generating a carry. And that's why I use the term carry trade, which is mortgages will be more expensive than the cost of borrowing for banks. So in good times, banks will actually make profits. But when the losses come about, some of them will be so large to fail that actually they'll get bailed out in the end. So my view is very simple. We just had a big regulatory failure, in my opinion. Yes, there were sort of incentives at play. We were in a benign economic environment. There was a lot of global liquidity. But I think if there had been right controls in place to actually curb these carry trades that were going on in all parts of the financial sector, I just gave one example, I think the end would not have been so painful for the taxpayers and for the rest of the economy.
Thank you. Raj?
Well, thank you very much, first of all, for having me here. It's a real pleasure to be with all of you, and particularly Hilary. I'm glad we started this way because I do think it's important to take a short look backward, because we need to figure out what went wrong before we can decide what we're going to do in the future. And at the same time, that look backward has to be a search for solutions and not a search for villains, because if we focus on villainy, and there was some, but not an awful lot, we're really going to miss the solutions to the problems. I would certainly agree that there were severe regulatory lapses, but a crisis of this magnitude certainly had many sources. And with all the regulatory lapses, the regulators didn't make the bad loans. That was left to the financial sector. Focusing just on the regulatory side, I would identify 2 or 3 of the most serious problems. One was clearly that you cannot have a financial system which is partially regulated and largely unregulated. I think you can, I mean, you've got some distinguished academics, but I would say that you have a regulatory corollary to Gresham's law, which is that bad money drives out good, bad regulation or no regulation drives out good regulation. And we had this enormous shadow banking system that was either unregulated or underregulated, and even parts of the banking system were underregulated. So that was one major problem. A second major problem was that the regulators simply lacked sufficient information to do their job. Even today, no one really knows where a lot of the exposures are in the world, because some of these somewhat esoteric or highly esoteric instruments to which Paul referred, such as credit default swaps, you can build swaps off of swaps and hedges off of hedges, and you really don't know where the risk is. So it's very hard to gear a regulatory system when you don't know where the risk is. And third, and this is a preview of, I know, another issue we're going to come to, there was a total absence of an effective resolution regime, so that when a Lehman or a Bear Stearns or the GSEs got into serious trouble, there was simply not a regime available to deal with them. Regulators and the government were confronted with an absolutely unacceptable choice, either huge taxpayer exposure or free-fall bankruptcy.
Well, me, myself, being a regulator, I would have to agree basically with both, but Viral, I think, has a good point. It was, in my view, between the two, primarily a huge regulatory failure. I would have, being a regulator, agree with that. Basically, we can say that risk management systems in the financial sector failed because they were taking excessive risk. They were giving the credit, but as one of the people said in the industry, this is an industry where when music plays, you have to dance. And I can tell you that I had experience as a regulator of a chief risk managers from the bank coming to me and complaining about the carry trade. In our case, much of it was happening in the FX carry trade, so basically banks borrowing Swiss francs or yens and extending loans in the domestic market. And they would come to me and say, look, this is crazy, this is becoming extremely risky. And I would tell them, but you're the chief risk managers, why did you come to me to tell me that? I mean, you are the ones that should warn your CEO. And they told me, yeah, but I mean, if anybody in the market is doing it, there's nothing we can do. I'm sure that you had many episodes during the crisis when the chief risk manager would come to the CEO and tell him, look, I see risks here. And I guess the CEO would say, well, why don't you sit here, have a whiskey, we'll discuss it. But, everything is going on so well, bonuses are coming, and he would simply shut him down. Or he would say, look, if others are doing it, we have to do it. And that's where regulators should step in, because there's nobody else. Now, the regulators didn't do that. Of course, it was not easy to do it. It was not easy to see, I fully agree, all the risks that were there, but I'm sure that some of the risks were more than obvious. And I also do not agree that we didn't see many problems before the crisis erupted. You had many people writing about the problems from, for example, Fannie Mae, Freddie Mac, including Greenspan himself, about asset price bubbles, about the huge leverages. I mean, the leverage in the 5 investment banks increased in 10 years 20 to 30 times. 20 to 30 times. I mean, regulator cannot sit down and say, well, there are no risks here if something is in. But nobody did anything. Now, I agree. The question now is why nothing happened and what can we do that in the future we do not see these things happening again, because it will be very difficult to change the incentive system within the financial sector. This is probably something that we will discuss further on.
Let me ask some of the panelists to discuss elements of the other discussions. Raj gave us 3 sort of elements of where he felt regulatory lapses existed. You talked about regulatory failure without being as specific. Are there specific elements that you would sort of identify which are the same or different as the regulatory lapses that really characterize the situation?
No, I think I broadly agree with you that I think absence of resolution regime is absolutely the key problem, because when a large institution fails, then we don't actually know how to fold it up. And because we can't fold it up, but it's performing a lot of activities, regulators get compromised at that point. I think I also agree that lack of regulatory information was a big issue. I think shadow banking world, which I'm sure will come to, I think when we talk about reforms, will be there. I think if I had to point sort of one thing that I think was not there, which is slightly different from the 3 points mentioned, was that we can put resolution systems in place and hope that in future when large institutions fail, maybe we don't have to do bailouts and so on. My own look at banking crises in the last 40 years around the world has been that there will be more crises in future and there will be more bailouts. I think no matter how hard we try, invariably a new problem comes up each time, something that you've not actually fully fixed through your systems before. And so my view is that these large banks, large institutions, systemic institutions, they should actually be charged in good times for the fact that they are actually taking on risks that might bring them down. And when they are brought down, there'll be taxpayer losses, bailouts, and so on. And I think the reason why it's important is because they need to be given incentives so that in good times when they are actually becoming systemically very large, they think twice. Should I actually pay the higher cost that I have to pay for becoming systemic? And is it still worthwhile for me to do so? Or should I actually cut back? And I think many activities might cut back if they are actually made to pay for the costs of bailouts upfront. But I think this is something we'll come back to later on. So to just finish, I think I said that large institutions are not paying a fair price for raising funds in the market. And this is what I really meant, which is effectively those who give debt to large banks always get bailed out in a crisis, which means they are really not actually charging these banks too much because they expect the bank to be bailed out in the first place. So one way you can fix the problem is to actually charge them for the subsidy that actually you are giving to the creditors of these banks in good times.
Raj, do you agree with Boris's view that there's a herd instinct in the financial sector, which leads to some extent, perhaps, I think he was implying, that regulators get captured and there's some momentum which is just hard to stop?
No, I think the point is well taken, and at the risk of extending the metaphor, I think the regulators need to be more like the Australian sheepdogs, which are out there nipping at the heels of the herd animals, as opposed to lapdogs, which just enjoy staying on the sofa. I like lapdogs, but not necessarily for regulatory purposes.
Boris, Viral has this rather pessimistic view of the future. More crises, more bailouts. Is that going to characterize the global financial system looking forward?
I'm afraid yes. If I have to be honest, yes. I think that we'll do quite a lot to improve the system now. And if you look at the initiatives of the Basel Committee in Pillar 1, 2, and 3, they are all right initiatives. We'll see how far they will go, because we'll have 2010 when these things will be tested. And then the banks will complain. They will say that these are too high capital charges after the calibration, and they just hope that the Basel Committee will not take a step back, but will really increase the capital charges. But this is kind of something that is done at the international level for all banking system. Also, regulators, as we know, under the Basel Accord have the discretionary rights to intervene with the capital charges, to change them at their discretion when they deem it's necessary. It is interesting that they very, very, very rarely use that discretion right. And in the end, I think we can design whatever kind of improvements to the Basel II. We can do whatever we want, but without the regulators really discretionary moving and changing the capital charges for different banks when they deem it necessary, it will be very difficult to have an efficient regulation. Real has said that for some, as far as I understood, you said for systemically important institutions you have to charge them higher charges, kind of capital buffers, and or maybe to create disincentives for them to grow too rapidly. I don't know. It's a good idea, but the implementation will be, of course, very difficult. That will also involve some degree of discretion of the regulators. The question is who will do it, for which banks, and it's not clear what the answer is. Unfortunately, regulators will, I'm afraid, shy away from too much discretionary decisions, and the banking industry is global and it operates everywhere. Whatever is done, we know, has to be applied everywhere in order to avoid regulatory arbitrage. If we leave a small, part of the territory uncovered, it won't work, as has been said before. Of course, there are other solutions, like breaking down the institutions to smaller ones, which will not be systemically important, or going to the narrow banking. But I think these things are even more unrealistic, and I don't think that we'll see anything like that. Breaking down the institutions theoretically is a nice idea, but let me see who will do that, in which country the government will break down their big banks. Because the logic of the market is the bigger you are, more business you'll have, and nobody will want to hurt their own industry.
It isn't obvious from the economic and sort of analysis of the banking industry that there are such great advantages to being as large as some of the banks around the world are. But nevertheless, there seems to be a desire to grow. Boris, you mentioned the fact that Basel II regulations do give regulators a great deal of authority to increase capital charges, and that rarely, if ever, gets used. There was also a great deal of authority on the part of American regulators of things that could have been done, which were not done, and so that sort of pushes us in a direction, and you've all started talking about it, of looking forward a little bit. That in terms of looking to the future, what kinds of institutional changes in a fundamental sense, not specifically, but let's begin in a fundamental sense, have got to be put into place to make sure that these kinds of systemic failures of the modern era, if confronted again, can be dealt with. what are the key reforms that, in your view, must be put in place? Perhaps I'll start again with Viral.
I'll just use the list that we discussed earlier. So I think we discussed the fact that we don't have ways of folding up large and complex institutions. We lack regulatory information of certain types that could contain the losses when some of these institutions fail. We have a sort of a parallel banking sector to the regulated banking sector, consisting of hedge funds, money market funds, derivative contracts, which are completely bilateral and not regulated by anyone. And then the point that I had added, which was the fact that they are not actually paying for the fact that they are large, complex, and will get these subsidies in future. So I think that each one of these requires quite a bit of careful thought into how to unify the existing regulation with parts that are unregulated and where to modify things. So I'll just talk a little bit about what things are being proposed and what things are glaringly missing, in my opinion, from the whole problem. So what seems to be currently under debate at both at the House and the Senate is that they are talking about a systemic risk regulator. They are thinking about what they are calling as a systemic risk council, which is going to have representation from some of the key regulators, such as the FDIC, which takes care of commercial banks, Securities and Exchange Commission, the Federal Reserve System, CFTC, which is in charge of the derivatives, and so on. And one of the plans which is being floated is that essentially a group of institutions based on certain criteria, such as their size, how central they are to particular markets, how much leverage do they have, how interconnected they are with other institutions, will be classified as systemically important institutions. And they'll be regulated slightly differently than others. So, for example, one, they will have to prepare what are being called as their living wills, which is, in case they fail, how do we actually fold them up? What are their various subsidiaries? What kind of activity sits in what kind of subsidiary? Who are their various counterparties, and so on? One of the parts of the living will is going to be that there'll be a part of debt of the firm which will just automatically become the equity and bear losses when these institutions go down. So it will no longer remain debt. You no longer are owed any money by this firm if things go sufficiently bad. And they are actually also talking about a systemic risk fund along the lines I was mentioning earlier, which is that they will put together a fund which may be used for whatever expenses are required to be incurred, maybe some bailouts, some other types of expenses during future financial crises, not just of these institutions, because it could be that there is some other institution that failed and became systemic, even though we thought it wasn't systemic, but that currently the ones that are identified will actually pay an ex-ante fee to get into these. Then the over-the-counter derivatives markets, they are trying to unify these markets with the derivatives that trade on exchanges, such as on the Chicago Board of Trade, the Chicago Board of Options Exchange, and so on. But I think these are fairly complex reforms that are coming out. And of course, over time, different implementation details will be worked out. I think that these are two of the important things that are being done. Dealing with systemic risk, systemically important institutions, and dealing with the over-the-counter market. Things that are not being done, and to me this was a big surprise, which is in the entire 1,500-page bill that has come out, there is actually not a single mention of Fannie and Freddie. There's basically no mention of government-sponsored enterprises, which leading up to the crisis, partly actually had a hedge fund operation, even though they are effectively backed by governments. They were effectively acting like a hedge fund because they were buying all these subprime tranches from investment banks. And not to actually talk about how to deal with them going forward is in my opinion, a big omission. There is not much of a mention of the insurance sector. Clearly, one of the big problems was AIG. And you can think about AIG's business model. They basically sold $450 billion of insurance to other financial institutions for payouts, essentially when the world came to a stop. Now, they were not holding that kind of capital, so it's clear they are not going to be able to honor these promises that they have made. So these kinds of guarantees should not be allowed to be sold in the first place without capital backing them, but there's not much of a mention about them. And then the third thing I would point out is that there is a huge money market sector out there, which basically just looks like banks. They collect deposits from individuals like you and me or from corporations. They invest in slightly longer term assets. They are restricted to investing in assets which don't have more than one year of maturity. But so they are just like banks, but they are not subject to any bank regulations. They don't have deposit insurance. They are not subject to capital requirements. And when Lehman Brothers failed, we had a huge run on this about $3 trillion part of the sector, not on the entire $3 trillion, but on a big part of this thing. And now we had to come out and effectively start bailing out everything. We had to bail out money market funds. The Federal Reserve had to start buying out those who were debt of those who were reliant on the money market funds for funding and so on. So this was like a big part of the financial intermediation sector, which is like banking sector, but we've not been thinking about it. And even though there is something in the proposals, I don't think they're very clear about what they need to do. So I would say there are few steps that are forward, but to me there are a few glaring omissions as well.
It's good to hear a little bit of optimism, because you seem to be saying that in those areas that are addressed by the legislation, you almost seem to be saying that Congress is doing the right thing. Imagine.
Yeah, I've been pleasantly surprised with the quality of stuff that has come out. There are problems, but you kind of just the way people are cynical about the industry. I think there are more people who are cynical about the Congress. But I think this was overall, I would say, a positive for me.
Raj, is that true?
I think the fact that Congress is willing to take up and debate seriously the need for regulatory reform is a positive. I am less convinced, however, that Congress is going down the right path. Let me take some easier, lower-hanging fruit types of situations and then move into more difficult ones, more complex ones. I think the idea in the Senate bill, as opposed to the House, of stripping the Federal Reserve of regulatory authority has got it 180 degrees wrong. This is the organization, whatever its faults, and it obviously has them, is clearly the most sophisticated, the most independent, and that is the agency that you want at least regulating our major institutions. So that is one flaw. A second flaw, I think, is a focus on one of three aspects of capital. If you really look at it, it's pretty simple. Regulatory capital is a simple formula. It's A, which is qualifying capital, over B, which is risk-based assets, equals or must be not less than C, which is the regulatory requirement. And C, everybody focuses on C. But what was really at fault was that too much junk went into A and not enough focus on tangible common equity. And nobody was willing to deal with the holy of holies that no asset could be risk rated at more than 100%. So you had these highly risky assets on banks' balance sheets that were rated exactly the same as a AA or AAA commercial and an industrial loan. So the failure to deal with A and B. I really think living wills, they're fine, but it misses the point. And the point should be, it's not what the financial institution comes up with. What was clearly lacking in 2008 or even 2007 was in the desk drawer, apparently, of the major financial regulators was a document which said, if this particular major institution gets into trouble, here's what we're going to do. Now, you can't be bound by that script, but at least you would have thought it through and be prepared to deal from a background. And let me at least touch on resolution because this is a much bigger subject. But I also think the process to date on coming up with a resolution structure has significant flaws. If you think through what happens at a Bear Stearns or a Lehman or the GSEs, any of them, on the first second after the institution is put into a resolution process, you have to have the answers to two questions. Question one, will creditors be paid, when, and to what extent? And question two, who's going to fund the institution while it's being resolved? And again, we can get into this more later, but I don't see any of the proposals in Congress dealing with those two fundamental questions which need to be answered to have an effective resolution regime.
Let me just interject a point, since I mentioned earlier that Viral is putting out or editing a new sort of volume on these issues, and the contribution I made was with regard to sort of the Federal Reserve, and commented on the Senate bill, but not the House bill, removes all regulatory authority from the Federal Reserve. And I agree with Roger's point that that was a mistake, but the question that comes up to my mind then is, how about when it comes to systemic risk? Does that also mean that the Fed should be the agency responsible for dealing with systemic problems? That's a question to you, Rob.
Yeah.
Well, I think it should be for the same reason. It is, as I said, sophisticated, most sophisticated, most independent, and it has the most information. To me, if you're regulating the major institutions, you really can deal adequately with systemic risk.
Boris?
I would agree with that, not only because I'm a central banker, but we had a discussion in Europe recently also about a setup of regulatory powers within Europe, which has even more problems than the US in some way, because we have one market, one currency, 27 regulators, and 27 deposit insurance schemes, which is clearly inefficient. But there the discussion was who's going to deal with the systemic risk of large institutions. There was an agreement that it should be European Central Bank. I would also think that in the US you cannot think of a better institution with better information, with better sophistication at the moment that can do it better than the Fed. It theoretically you might have, but you don't have. So it would be a clear conclusion that the thing should be really in terms of the systemic risk assessment in the hands of the Fed. The other principle I think which is important is that you should put, I think ideally, although it's very difficult of course because of the history of the regulatory structure and other things, as many systemic things under one umbrella. From payment system to the derivatives market. It's not just you take largest institutions. There are other things which are, as we have discovered,
you could be small and still generate systemic risks.
Or you could be in a niche part of the financial business and still be systemically important. So whoever does oversight of the systemic risk should have authority to look at everything which might be systemically important.
Paul, could I just add, I could not agree more with that. If you want to look at the four institutions, which if they fail tomorrow would have the greatest impact on the world's financial system, they would be the New York Clearinghouse, the DTC, Bank of New York, and State Street, because they are absolutely essential to the entire plumbing of the financial system.
Go ahead.
Yeah, I'm actually quite contrary on the role of the Federal Reserve for systemic risk institutions. And I think, let me just flag the issues. I don't have the right answer. And My sense is the Fed is becoming sort of like the banks themselves, becoming like a large, complex regulator. We have large, complex financial institutions becoming a large, complex regulator. The difficulty is the following, which is when we had the Depression and we had a large-scale failures of commercial banks, we could have actually entrusted the role of resolving bank failures to the Federal Reserve even in 1934. There was nothing that actually prevented that from happening. But I think the regulators, in my opinion, were right at that point to say, we need to set up a new institution. That institution was the Federal Deposit Insurance Corporation. It guaranteed the deposits, and then it basically, essentially, also managed how banks were to fail. So FDIC guarantees your and my deposits that are sitting in the bank. But then when the bank's capitalization falls to a sufficiently small amount, it takes it over and resolves these institutions. And the big advantage that we have of this model is that FDIC, when it takes up a failed bank like, say, IndyMac or Wachovia or WAMU, it has only one objective, which is basically to liquidate this bank in the quickest possible manner, but at the same time ensuring that FDIC basically gets the maximum
That's its
value.
legal mandate.
Yeah, that's its legal mandate, exactly. The trouble that I have with sort of the Federal Reserve actually coming in and doing this job is that that's not what Federal Reserve's legal mandate is, first of all. It's in charge of monetary policy. Effectively, the Federal Reserve has backstopped assets of Bear Stearns and AIG currently in the crisis, which means that it is actually bearing the credit risk of these assets that were sitting with these institutions. But now let's think about the following scenario. Let's say some of these assets are mortgages. 6 months down the road, because of all the money that's being pumped into the economy is getting overheated. And on the one hand, to control inflation, the Fed would actually like to raise interest rates. But on the other hand, on Fed's own balance sheet are sitting all these mortgage-backed assets, which if you raise interest rates are going to fall in value at that point. So now, if I am Ben Bernanke, I don't think I can be so clear in my mind that my left part of my brain is really just thinking about inflation and the right part of my brain is just thinking about these mortgage-backed assets which are sitting on my balance sheet. And I think that worries me a lot. And what worries me even more is actually the fact that suppose tomorrow a number of these mortgages on Fed's balance sheet were to default. Okay,
Which they will.
Which they might, and they will in some future scenario, then the Fed is actually going to have effectively lost money in the process rather than just having recycled liquidity in the process. And now, if we have a Fed that's in trouble or needs to do something about this, we are basically going to have Congress coming in. And now I absolutely agree that we need a truly independent Fed to sort of take these inflation decisions. But the moment the Fed wants to start doing the systemic risk jobs, for which I agree it is best suited, but I think it should not do it precisely because it is the kiss of death. The moment the Fed says, I'm going to bail out institutions, I'm going to decide how to resolve institutions in future, I don't think Fed will stay independent. The Congress will come in and say, why did you do this with this institution? Why did you not bail out this institution? I want to know what's on your balance sheet. I want to know in 6 months' time that the interest rate decision you take is actually not to take care of the mortgages on your balance sheet, it's actually to take care of the inflation in the economy. So I think Fed is the right regulator to do the job, but I think we have to bite the bullet and say we need to create a new institution that will resolve these failed banks in future and build the capacity there. I think we just have to accept that Fed may be the right body right now, but we might be making a big mistake if we actually make them the institution that's going to decide on failure of Bear Stearns, on failure of Lehman Brothers in future, and so on.
Boris, a European perspective on the role of a central bank as the resolver of failed institutions, and maybe some perspective on the banking crises in Croatia 10 years ago.
Well, yeah, in Europe we're not yet there to discuss it this way as you have put it. Basically, in Europe we have, as I said, a problem of too many. I mean, the failure of the European Monetary Union has been that there has been no integration of the banking market. You had the integration, full integration of money market. You had a good development of the bond market, but the banking market itself, although you have one market, you have one currency, has never really integrated. You have really 27 separate markets with 27 regulators. So the question there is, what can we do? Because these institutions really operate in the whole market. You do have systemic risks. The pool of risk is pretty much the same for them. And in Europe, we are going the way of creating the colleges of supervisors, which will deal with the home host issues. So we will have a well-defined processes that always has to be left to the practice to show how well-defined they are and how they operate in a real life, on the cooperation between different regulators in different countries. The ECB will be the one to take care of the systemic risk in a way of signaling to the colleges of supervisors where they see the systemic risks and what remedies they would suggest. But in the end, it will be on the system, on the colleges of supervisors to take the regulatory action. So in a way, the ECB is not the regulator; it is the one that will be in charge of, flagging the problems early enough for the European Monetary Union as such, which might be the role also for the Fed in the U.S. It doesn't necessarily have to be the one that will call the closure of the financial institution and be directly involved in the resolution of that process.
Yeah, I think this I agree with. I think I also endorse your view that I think Fed should be the supervisor. I think my concern starts when they actually start trying to bail out or say, you come and buy this guy, I'll backstop some assets, then I start having trouble.
No, and I agree. I think that's a very important dichotomy between who supervises and who makes the resolution decision. And they do not necessarily need to be the same.
But in between, there's some lending involved, and that's what was concerned Viral, is a central bank going beyond the traditional definition of a lender of last resort and lending in situations where there clearly is credit risk at stake. And if that's necessary, who plays that role between the lender of last resort function and the actual resolution or resolver? Who provides which was your question about who provides the funding to keep these institutions going while we probate their living will?
I would try not to raise the question with at least having some thought about the answer. I think this probably should be the Treasury Department, but before everybody gasps and says, there goes the taxpayer, actually it would be a more complex approach, because I would see the Treasury Department providing the financing, but the Treasury Department then being the first priority creditor in the institution, so that the Treasury Department is basically only at risk if the institution is close to valueless at the end, because the Treasury would come ahead of all the other creditors in the institution.
Is that what we've done, say, with respect to General Motors? Or close to it?
In a way, but not totally, because it's not total with whatever they announced. It was a great victory that the government would only lose whatever it was, 40 or 50 billion in GM and Chrysler today, down from 60 or 70. So I don't think it's been totally done, no.
Okay. Viral, any further comment? Or
Yeah, actually, This is really something that Paul and others have written in one of the white papers that we are going to release tomorrow. But I think one of the ideas they had was that maybe in an emergency situation, you might need the Federal Reserve to temporarily take over some assets, as they did in case of Bear Stearns, but that this should be allowed by legislation only if the Treasury, within a certain finite amount of time, say 6 months or 9 months, will take the assets back. They'll buy the assets back from the Fed. So Fed is just temporarily making a loan, warehousing,
And
but
the
the
idea-
assets ultimately, I think it's very similar to the situation you
And the
described.
idea being there that the institution with the expertise and the ability to move quickly is probably the Fed more so than the Treasury.
Also, I think there's sort of the little bit of nice thing about this is that I sense that if Treasury had to take a call on who gets bailed out, there'll be a lot more political problems than if the Fed is actually taking this decision. So there's something nice about this approach in also that while there may be some influencing going on, even, you can sit down with the Federal Reserve Governor and use some suasion. But I think that's it's likely to be a lot more independent decision than one that gets done through Treasury or the Congress. So.
Paul, could I
Please.
just turn to a point which Boris touched on, and I think it is so important. I'd like to elaborate just for a moment, and that's not merely the College of Supervisors, but trying to resolve the home host country issue. Who really resolves these institutions? How are they resolved? If there is one issue which is, to me, as worrisome as any in the proposals which are global, it is the concept known as ring fencing, where if a major global institution goes down, each country in which that institution is located would ring fence the assets and liabilities. This is the holy smoot tariff of a regulatory sort in this century. And if we go to ring fencing, which is widely accepted, surprisingly so by the regulatory community, not necessarily endorsed, but accepted, the protectionist aspect of that, I think, is very troublesome. And I've heard from several regulators, well, they can't afford to let their retail customers suffer because of something in the home country. There is an answer to that, which is to say, all right, and we actually have it in the States, which is that if you want to take retail deposits, want to offer retail services, that does have to be a ring fence. That has to be in a separate subsidiary and is insured just like any local bank. But if it's the wholesale markets to ring fence, I dread what will happen when the first large institution fails.
But would it mean then that the retail operation would be subsidiary rather than a branch initially?
It could be either, I think.
Because it's very difficult to transform it when the things happen. So then we should agree that it should be a subsidiary in every country as such an operation, and the rest can be then.
Yeah, I think that probably makes sense for the retail operations. Now, there are admittedly some inefficiencies in that, and in an ideal world, that wouldn't be the result. But I think in view of what happened, for example, in Hong Kong, what happened in Iceland, this is going to be at a minimum necessary.
No, I agree. I mean, these inefficiencies wouldn't be great. I mean, they wouldn't. The costs incurred in that would be relatively small. Of course, it's more efficient for a company to have everything, but I don't think that. Yeah.
Along those lines, there's been a lot of discussion in Europe, more so than here, about narrow banking. Whenever I talked about that over the years in class, I sort of rejected it out of hand. But there's serious discussion that perhaps the deposit-taking, money issuance, payment system activities of the banking system are really a public utility, as much as Con Edison is a public utility. And those activities should be fenced in, to use your terminology, into separate institutions which provide this payments utility and these payment services, and let everything else go its own way in the financial system elsewhere. Is there anything serious about it? Should any serious consideration be given to a proposal like that?
Not really.
I'm glad to hear that, because to me this is an extreme idea, but it is being advocated by people who are not extremists, and that's very worrisome. To me, that concept of narrow banking is narrow-minded because it forgets what banks are in business to do, and that's to extend credit. So what are you going to do with the loans? We would be right back in the problem if the lending function is separated from the deposit-taking function.
Yeah, I think I agree with that. I think one thing, though, that I've been sort of thinking about is whether certain aspects of Glass-Steagall Act that was put in place in 1934 were actually quite good. So there are two ways of sort of thinking about regulating banks. One way is that, yes, we give them some guarantees, some of them may be too big to fail, but somehow we'll be so good at charging them for their risks that in the end we'll get everything right. A somewhat more reasonable and I think a more practical view would be that we'll try our best to know what exactly they are doing and measure those risks. Based on those risks, charge them the right capital requirements, but that there's a pretty good chance that on some of these things we won't get it right. Banks are very innovative, they design new products, risks change even for the same products over time, depending on what kind of economic conditions we are in. So to sort of assume that we can contain these risks well all the time might be a bit too optimistic. So I've been thinking whether I'm yet to see an argument that convinces me that a bank that takes deposits and makes credit loans to corporations, households, etc., actually needs to be doing prop trading, which is basically saying that they take the principal and then they are just basically taking one-way bets in different markets in the economy, just like a hedge fund does, or just like sometimes I do on stocks in the market. And my own assessment is that the reason why Deutsche Bank has a proprietary trading desk inside it, and you will routinely hear this statement even in industry, that Deutsche Bank is a large hedge fund funded with deposits. I think the reason why that hedge fund exists inside Deutsche Bank is because it can actually raise cheap deposits with the backing of the German government, I think. So my sense is that this is one of the biggest problems out there, which is that carry trades, as I was mentioning earlier, are being done in all sorts of markets in these large banks, but they are ultimately actually funded with your and my deposits out there. So I'm not 100% in that direction, but I would actually favor complete separation of proprietary trading from these institutions. Let those be hedge funds. Hedge fund industry works very well. They are not reasonably, they tend to be not very large because they are left to private markets. They have to put up sometimes their own capital into these. They fail all the time. New hedge funds start all the time. And that is exactly, I think, what should happen with speculative activities. They should succeed. Sometimes they should succeed. And when they fail, people who betted on these activities should lose money. And new capital should become available to more guys who want to do this activity. So
it always amazed me when Glass-Steagall was repealed, that it was repealed because the banks complained that the investment banks could do pretty much the same thing, but weren't constrained in the same way by capital requirements. Because it seemed to me at that time that the opposite argument can be made. Sure, if investment banks do the same thing, perhaps the regulatory structure that we thought was necessary for the banking system needed to be applied to the investment banking structure as well. Raj, Boris, do we need to resurrect Glass-Steagall to some extent?
No, not Glass-Steagall. I mean, I agree with Viral when it comes to the proprietary trading, but that can be either separated from the bank altogether, or you can levy capital charges and say, okay, for all the proprietary trading, you have to have a full equity backing, and then you do the business with your own money, not with the other people's money, with the guarantee of the government. So one of the other solutions should be applied. Both could be effective, I think.
At the risk of being a little technical here, there is an irony. There are 4 sections of the Glass-Steagall Act. 2 of them were really in play. The one which was repealed was Section 20, which prohibited affiliations between banks and securities firms. And I think it's very hard to demonstrate that that actually contributed at all to the problem. I mean, you go down the list of the major failures, not one of them was a result of a Section 20 problem. Section 16 prohibits the proprietary trading, or should. It prohibits investments with some limited exceptions. And that was not touched, but it was also not enforced. And I agree, you could either pull it out or you could deal with this, and I think it's exactly right, dollar for dollar capital charge, because that's what a hedge fund would have.
All right, good. Well, we've been talking about what should be in banks, outside of banks, in terms of the regulation of traditional banks, but we have not gotten back to an area which was discussed at the beginning, which is the shadow banking system. Viral pointed out that many of the elements of the shadow banking system are explicitly omitted from the regulatory proposals in front of the House and the Senate. And we know that some of the problems that we've faced have come about through the activities of things in the shadow banking system, including hedge funds, derivative markets, insurance companies, and other things. To what extent must they be brought under the same or a different regulatory umbrella as the banking system? Viral, you want to start? You're closest to me, so I pick on you first.
So this, of course, is a very difficult area overall to deal with, because there's in a perfect world, one would hope that sort of, everything is regulated in a very unified way. But it's very hard to sort of achieve that. So to give you an example, on the one hand, hedge funds sometimes do many activities which are currently being done through prop trading desks inside these banks. But they do it with different leverages, etc. We've had one large hedge fund fail in 1998. I think it was perceived to be a systemic crisis at that point, even though now it seems like a very minor problem compared to the one we have seen right now. And to just give you an example of why this problem is so difficult. So, for example, my colleagues at Stern who have written on the hedge fund regulation for tomorrow's release, their basic view is that hedge funds did not contribute. There's no evidence that they contributed to this crisis in any significant way. And we should probably sort of leave them out. With the caveat that they could become systemically important in future, and so we should keep them under the radar screen. And I think that second part is very important, say, in the hedge fund context, because the week when Goldman Sachs and Morgan Stanley might have collapsed, which was basically the week after Lehman Brothers went under, or at least I think they would have collapsed without government support. Citadel, actually that very week, thought that they could basically move into the market for becoming the single most largest dealer in derivative products. Because at that point we were looking at the top 5 investment banks in the United States. Merrill got into Bank of America, but otherwise Goldman and Morgan Stanley, which are actually the bigger players in the over-the-counter derivative space, that these would basically not exist, creating a huge room for them. Now, if a large hedge fund tomorrow was to become the central counterparty effectively to a large number of derivatives trades, I think going back to the point Boris had made earlier, that is sort of like a public utility function, and we should actually view them as systemically important. So I think for me this is a very hard line to draw, except that my own deep instinct and is that most of these new forms of financial institutions that come about, money market funds, hedge funds, if you go back and trace their origins, they are almost always to actually get around some existing regulation. So to give you an example of the money market funds, the first money market fund, the reserve fund, which actually failed in the crisis, was set up in 1971. And that time, the reason why it was set up was because so money market funds are just like savings deposits. We go there with the intention of being able to pull out our money whenever we want. But at that time, bank deposits had ceilings on the maximum deposit rate that they could pay, and the ceiling was actually set by the government. And importantly, the ceiling set by the government was inflexible in the sense that many times it would actually be lower than, say, the 3-month commercial paper that Goldman Sachs had actually issued in the market. So why did it make sense to set up a money market fund? It made sense to set up a money market fund because you could basically take savings and promise them higher interest rates because the banks could not at that point. Now, of course, there's a sense in which this activity is actually just like a banking activity, which is to basically take deposits from households and lend it out in the form of commercial paper to institutions out there. So while I can see that there is some benefits of these kinds of institutions to exist, I sometimes worry that many of these institutions may actually not be viable if they were subject to the same capital requirements as regulated institutions. So personally, I'm very split on this issue. I need to think a little bit more. But let me sort of leave it at that. Yeah.
But you were clear earlier that ensuring financial instruments is probably something, as AIG did, which should be brought into the regulatory framework.
Yeah, I think that's right. So in the case of AIG, whatever they did was almost entirely systemic. They basically sold, at least AIG financial products, because the whole idea was that the deep crisis events that are very unlikely to happen were basically being insured by AIG. And I think I can get into details, but that was actually another big regulatory arbitrage. Maybe since I have a European regulator here, let me just mention this. If you look at AIG's December 2007 statement, there's a very explicit recognition that about $350 billion of insurance that they sold to European banks was actually sold for regulatory capital relief and not for risk mitigation. And my sense is the reason why that market failed is because the end banks that bought insurance from AIG actually didn't care whether AIG honored this insurance in the end. Because if they cared about this, AIG would sell less insurance, and that would have meant higher capital charge for them. So they had to balance this trade-off, which is, do I get more insurance from AIG, or do I require AIG to actually post higher collateral margins or require higher capital on all these things?
In terms of, they were buying regulatory or capital charge relief,
exactly,
for which they were willing to pay. If they really thought they were buying insurance, they would worry about the ability of the insurance company to pay off.
And I think this is the classic example of how the risk leaves the regulated banking sector, goes into an at least not regulated by the banking sector. So AIG financial products, they bought savings and thrifts bank, and they got regulated by Office of Thrift Supervision, which was an extremely weak regulator, or is a weak regulator in the United States. So effectively, we had risks being taken by the banking sector, but ultimately residing in parts of the financial intermediation sector, which are extremely weakly regulated. Now, I don't know whether regulators can keep catching up with this innovation activity that's taking place. And so at some point they'll have to draw a line and ensure that the parts that are the most important are held well. So my sense is, I think money market funds are very important, in my opinion, to bring under the regulatory landscape, because they basically have $3 trillion of deposits, say, in the United States. In contrast, hedge funds I'm less worried about, because it's a much smaller pool, and it's primarily institutional and high net worth individuals. And I think it's not going to disintermediate economies when we have large-scale hedge fund failures. Even we might see some capital markets suffering stress the way LTCM's failure might have created stress. But I think the stress we saw from failure of the primary reserve fund and the money market funds was of a far greater magnitude than what would have happened if LTCM had failed. But I think it's a very tricky question for me. I don't have clear answers.
What you said points to some extent to the answer to the question. In a way, you should have as many things as possible, either under one umbrella, or you should have a continuous kind of a consultation between the different regulators, not nationally, but internationally, to fix the system wherever there is a need to fix it, to avoid things like the one that you have described. And I think this is something that has been realized, and we are moving into that direction. Whether we're going to go, quickly enough and far enough, and how capable the regulators will be to keep up with all these things, we'll see. But at least I think that in the regulatory community there is a realization of the need to move, into much closer cooperation on the international basis. Otherwise, it's very difficult.
Do we have the institutional structures to lead that process?
There are contours of the structure that are now been sketched, but not yet. We are moving into that direction. I think next year it's going to become clear what the proposal will be, and there will be some agreement on the architecture.
Yeah, the G20 communique was sort of strong that they want that, but it wasn't quite sure what it was.
Sketched, but we don't know yet how it's going to look like.
Raj, any?
A few thoughts. This is perhaps at some risk of repetition, but a couple of the points that Beryl made, both in response to the last answer and very early on, I think really do bear repetition because they are so important. All these books are written about Lehman and Bear Stearns and Morgan Stanley and so forth and so on, but there was no greater crisis than the total freezing of the money market funds. The $3 trillion of largely, well, maybe half was retail, half was wholesale, but not only were all these sources of your daily funds frozen, but the entire commercial paper market came to a resounding halt because the money market funds were the largest buyers by far of commercial paper. This doesn't mean that the money market funds should be regulated like banks. They're different than banks, but the idea that they should be totally without regulation makes no sense. The GSEs. The idea that they are not covered, the GSEs were one of the major sources of the problem. And, it is frankly a scandal that even today you've got not only Fannie and Freddie, but the home loan banks, and there is not a director of the agency which is supposed to regulate them. So how much regulation is really happening? That position has been vacant now for months. So I think we do have to look at regulating institutions other than just banks. Again, I thought Vera made a very, very important point about how these types of institutions spring up because people want to escape regulation, and you can give example after example. AIGFP is another, the monoline insurers, which did the same thing, albeit on a slightly smaller scale. The mortgage bankers and brokers, particularly in the West, who they grew up because the banks were too tightly regulated, at least in relative terms, in their mortgage lending. So we immediately went to mortgage bankers and brokers who were glad to make loans without documentation, without underwriting standards, and the whole system was ultimately polluted.
Let me go back to a point which has come up in passing. We never really thought very much in this country about banking institutions being too big to fail, because we were used to the idea that there were thousands upon thousands of banks in the United States. Well, there still are 5,000 plus banks in the United States, But in the last 10, 15 years, there's such an enormous amount of consolidation of the banking industry that a majority of all banking deposits in the United States are concentrated in a handful of very, very large banks, which we now understand are too big to fail. I mentioned a few moments ago that the economics literature doesn't seem to recognize any great value of having these enormous institutions. Is there any valid argument that these institutions should be broken up, that we'd be better off with a more fragmented financial system than we have now? I'll start with Boris, since I've been picking on Viral first.
Well, I would say that, as I said before, that we will not see these institutions being broken up for sure. That's not going to happen. I think that the market logic, the market will tell you, yes, there is a value in having the large institutions and larger institutions. If you look at, for example, the amount of the wholesale international financial market that is controlled by the big banks, it's a very profitable business and a lot of money. And the bigger you are, more likely that you will have a market share and role in that market. So these are probably the most profitable institutions that we have, and it's extremely unlikely, because of the market logic, that we will see them broken up. I don't see who will do it, and who will be the one to lose this advantage of having such institutions domestically.
Raj?
I think if you try and look at the empirical evidence, it is very difficult to conclude that size and concentration correlate with safety and soundness risk. After all, the two countries which probably came through this the best of size were Australia and Canada. And Australia has 4 banks for all practical purposes, and Canada has 5. And yet they did just fine during the crisis. So the correlation is certainly not proven. And I also think it's important not to exaggerate how big the U.S. institutions are. In fact, the U.S. is considerably less concentrated than, I think, any country in the world. We do have a 10% deposit cap on any one institution, so you have 3 which together have roughly 30%, but the next, I think you need to get about 20 more before you get to another 30%. So actually, we are a fairly unconcentrated banking system.
Yeah, I think I concur on this. To me, size by itself doesn't seem to be the issue. I think I don't, Fidelity is a very large institution, but I don't think it is systemically important. Because it doesn't have any leverage, so so I think just looking at size by itself is sort of a very narrow way of thinking about what leads to failures. I think interconnections, the extent of short-term debt you have relative to the liquidity you have, or the maturity mismatch you have, I think these things are probably far more important. If I can just touch upon the very interesting point mentioned on Australia and Canada, and I think so one of the things that seems to be true is that there is this sort of tension between the industrial organization view of what is efficient, and I think a financial stability view of, I think, what is efficient. So if you talk to an economist, and in a world of sort of non-banking, you just thought about an industry, they would say competition is actually good. You should have many players, and that's going to lead to efficient prices, efficient production. One caveat would be that, if there's too much competition, we might not see much innovation, but we have patents to get around that problem and so on. But I think that in the case of the banking sector, because of the presence of leverage, I almost think that the intuitions actually goes in somewhat exactly the reverse direction, which is you actually want to have fewer institutions, have a concentrated system. Yes, it might not necessarily produce all kinds of efficiency that a very industrial organization view of the industry will produce, but they have so much to lose from, precisely because it's not so competitive, they are actually making a lot of money in their traditional businesses. And they would have so much to lose from actually blowing up their franchise that they might actually act in a much more prudent fashion than otherwise. Now, of course, this is just a thesis, but I think Australia and Canada are, very interesting examples, which I think seem to gel well with this.
Since we're wandering around the world a little bit, let me perhaps take us to this building, which is the New York headquarters of NYU Abu Dhabi. And Hilary earlier was talking about the opening of NYU Abu Dhabi's temporary headquarters in Abu Dhabi just this last week, and ask you whether two questions with regard to that part of the world. Number one, if you look at Abu Dhabi, sitting on a large amounts of sovereign wealth funds and a great deal of resources, what role might they play or do they play in helping the world avoid financial crises? That's a broad question. More specifically, we know that down the road from Abu Dhabi, there's been some difficulties in Dubai, in the private sector, but the private sector which is really very closely connected, or private sector activities which are owned by the government itself. Are those just bad business decisions, or are they indications of financial crises spreading to other parts of the world with increasing frequency, as Viral warned us of a little while ago? What's going on in the Gulf region, and how does that relate to the incidence of financial crises in a way that might concern us? Boris, since you're closest to the Gulf region,
Well, I think that the main kind of consequence of what has happened there is it's not a huge financial thing, in the first place. But there is one international important repercussion, and this is the one where this quasi-sovereign risk will be viewed differently from now on in the markets than was the case before. I would guess that if you talk to 100 bankers before that happened, 95 of them would tell you, oh no, it's a sovereign risk actually. Maybe 5 would dissent and say, no. Lawyers would probably say, no, it's not. You look at the papers, it's not guaranteed. But the bankers would consider it like that. Now they would think differently. Now, I guess next time around, you would go and ask them. There would probably be, I don't know, depending on the case, because everything is case specific.
But that sounds like a healthy change.
It is actually. It is. It's a good thing in that sense. It's not a good thing for Dubai, of course, but it is a good thing for a risk assessment by the banking community, and. It is basically their fault. They haven't been looking properly at what they were doing. They assumed things wrongly, and it's up to them now to. We discussed a little bit. I'm not sure how it looks like there, but I guess what they can do, that this company has some assets that they can seize now. It's not guaranteed by the government, but seems to me that they might have assets that the borrowers can seize at the moment, but I don't know the details of how it looks like that.
So it's just a bunch of bad business decisions and not a precursor of further systemic issues.
I think so, and another probably failure on in the risk management of the banking society of a different kind, but also helpful that has happened, so they will change their mind in the future.
Raj?
Just two very quick comments, one to each of the questions. I think the value of the sovereign wealth funds has clearly been proven as a result of the financial crisis. I mean, just think if the billions and billions that they put into Western financial institutions had not been put in, how much worse the situation would have been. And the view of a year ago that was dumb money actually has been proven to be quite inaccurate, because many of these investments turned out to be quite lucrative. With respect to Dubai, I think not surprisingly, when we talk about a financial crisis, there's a lot of doom and gloom. But if you want to talk about one really positive development over the last, however long you want to go back, it really is Dubai, that we were still in a fairly difficult situation globally, a lot of uncertainty, and Dubai could have been the match to light another major conflagration around the world, and it didn't. And I think that is quite a positive note.
Viral?
Yeah, I think I broadly agree with these views, and so I have this sort of view that you can't just kill default risk. It's going to show up somewhere or the other. So, for example, I mentioned that a lot of derivative contracts which were trading bilaterally between banks, many of these are now moving on to clearing houses. But that is going to mean that in future times, sometimes when things go bad, it could be that maybe some of these clearing houses will collapse. We've had countries that have taken on their own balance sheets a lot of bad assets that their banking sector created. Some countries will be able to deal with it just fine. But I think we should not be surprised if these bad assets actually create significant problems for some sovereign balance sheets. So my sense is sovereign risk will probably remain high in the next 5 years. I think we might have some other surprises. I think I just read that Greece has now, basically reached an extremely low credit rating. I think the lowest possible, out there.
But you can buy insurance.
Yeah, but very expensive.
Very expensive one. So,
As I look at my list of questions, I think I have posed every one of them, but they've been answered by our panelists. Or the other of our panelists. Sir?
Well, we've discussed, the significance of having regulation, but I'm also concerned about the human factor, getting people in the regulatory agencies who are motivated to act decisively, who have the caliber and the competency to understand the complexity of our financial world, and finally, how are they going to be compensated versus what they could achieve in industry? For instance, a good financier is going to go to Goldman Sachs. He's not going to go to the SEC.
Well, I would be glad to start. I very much agree with the thrust of this question. I'd like to take maybe $10 billion out of TARP and use it to upgrade the compensation for our U.S. regulatory agencies. You're never, ever going to eliminate the compensation gap, but by raising the compensation, it is going to have a very powerful psychological message, which is we care about the people who are there doing the regulation. And at the end of the day, you can have the best system given the choice, best system in the world or the best people in the world. That's an easy choice as far as your regulatory systems are concerned.
I can add, I agree with that. The other thing that is very important is to have right people to lead the institutions, which have independence, resolve, courage, if you want, to do things. I think that was also missing, at least to some extent, during the last crisis. Every institution, like the regulatory institution, depends heavily on the top management and what they decide and how they decide to do things and to act.
Yeah, the thrust of the question wasn't who do you put at the top. I don't think it's any problem to find a head of the SEC or someone who's willing to be head of the Federal Reserve. But I'm talking about the people who actually have to implement the policies of these regulatory agencies.
No, $10 billion would go a long way.
That's true.
yeah.
Another question? then I guess you've answered just about everything. We've been at it for a while. I really do appreciate your comments and the thoroughness of the analysis and acknowledging how complex and difficult it is. And I hope we're in the midst of doing the right thing in terms of changing regulation and not really embarking on a 21st century era of repeated financial crises. But we'll see how things unfold. Thank you very much for joining us.